Alright, hello. This is going to be a quick lecture on balanced and efficient price delivery theory. So let's get straight into it. So first of all, with the fractality of price, we know that there's 4 levels to price delivery, where we first have MMXM, or market maker models, where we actually switch from buy to sell programs and sell to buy programs. We have deferred rebalance, and we have immediate rebalance, as well as breakaway gaps. So it all depends on the time frame that you're on. It doesn't exactly matter what time frame. It's not like there's secret time frames for PD arrays. It's more about just seeing the expansions and retracements, because that's what actually rebalances price. So here's a quick diagram. So here we have the super low time frame, medium time frame, high time frame. So here is an example of a market maker model where we are trending upwards, then we trend downwards to rebalance some sort of higher time frame PD array or imbalanced price range to then continue higher. So we're switching from buy to sell to buy to sell to buy to sell. Okay. And then on the low time frame, what that looks like is just one-sided order flow where we're bullish, we're retracing to bullish fair value gaps. We're testing mitigation blocks, breaker blocks, etc. On the medium time frame, what this might look like is pretty similar to this, except it's moving quick enough that we don't actually have those fair value gaps, and instead the wicks of the candles are immediately rebalancing to old highs. And then on the high time frame, what this would look like is just a singular large candle or series of candles, and that is considered our breakaway. So market maker models, deferred rebalance, immediate rebalance, breakaway. So we also have IOFED, which is kind of similar to breakaway gaps because we're not actually filling it all the way, but on the low time frame it is balanced. So deferred rebalances on the low time frame are immediate rebalances or IOFED on the higher time frame, and breakaway gaps on the even higher time frame. So this is why breakaway gaps occur on every time frame, and why they become drawn liquidities after the low time frame draw has been reached, because efficient delivery must occur on all time frames simultaneously. So for example, in this schematic, as we can see on the super duper low time frame, price has been efficiently delivered. Then once we reach some sort of key level, we just reach some sort of standard deviation target, PD array on the left side of the curve, liquidity, etc. We begin to retrace. This whole price leg is actually balanced on the low time frame, but on the high time frame it's not, or on the low time frame here, it's not actually balanced. So that's why it has to come back and rebalance it, even though this is already rebalanced. So on the super duper low time frame, we're actually switching programs, and on the low time frame, we're simply rebalancing. So here's a little section on engineered buy-side liquidity. This is how you know when the low is actually in. So you need to actually know when a price range has been balanced, because a lot of times if you don't know what's going on, when price is messy, when we're chopping up, that's because you're about to become engineered liquidity. So understanding that there's still unfilled orders and now engineered liquidity, it becomes twice as powerful and even more of a reason for you not to enter yet or put your stops there. So just a quick note, we reject balanced price ranges and we attract imbalanced price ranges and liquidity. So here's a quick schematic. Here we can see that price has ran higher, retraced lower, ran higher. So everything in here below this line is balanced. And so as we come up higher and we retrace, we come up higher, we retrace, you think, okay, we're just going to keep expanding, expanding, expanding. And when in reality, this is engineered sell-side liquidity. So this leg, a lot of people will think that this efficiently delivered price. However, because we didn't actually tap into this fair value area, there is still this gap in here that is yet to be balanced. So now price will chop up in here. We're engineering sell side. We take out the sell side, deliver price into the balanced price range, fully completing, like ICT said, rolling the paint roller to make sure that we're fully balanced in here before we can finally expand and continue higher. So this is a really, really important concept. Here's a couple examples. This is one that I called out previously. We had London low here. I mentioned this a little bit in my previous video, in the simple model video, but here all of this is just engineered buy-side liquidity. We know that this price range from here to here is imbalanced, so we need to run that, deliver efficient price delivery into that leg, and we're taking out this engineered buy-side liquidity where we can then finally reject from, which is what ended up playing out. As you can see here, all this engineered buy-side got taken out. We reject because we've efficiently delivered price, and we're rejecting the balanced price range. So now we can continue lower until we finally got S&T down here. Here's another example from today where this is the scenario that I was looking for. This is what I posted on my TikTok. I was looking for price to continue to draw all the way down here, and because we did not reach that, I was not yet looking for longs. People might have been thinking, oh, we retraced into this 1 hour gap, whatever, 15-minute gap, and now we're just going to expand higher, right? But we don't have any SMT here, we don't have any SMT here. We're simply chopping up and down and up and down and up and down. And as you can see, we still have this imbalanced price range, whereas this down here is balanced. So price is eventually, ideally, going to continue to consolidate until we finally drop lower, taking out the buy-side liquidity, everything that's engineered above this line, and it's only going to be able to expand away once we actually touch this line and deliver efficient delivery. So looking back, I was actually looking back on one of my trades which I got stopped out on. This trade I would have been set to make $7,000 across my XFAs, and instead I got stopped out, as you can see. So my original long entry was right here. I know this is kind of hard to see, but looking right here, you can see that I entered inside of this BISI. You know, we dropped lower from midnight open. I was expecting, okay, we're going to continue and rip higher from here. But instead, as you can see, we chopped up, and then during London session, what actually happened is we dropped lower. And I want you to look very closely to see where we dropped lower into. Okay, so we had this move higher, we had a high right here, retrace lower, formed another high, retrace lower, formed another high, retrace lower. So I was expecting, you know, if we're going to continue higher, we're going to continue higher from here. And instead, as you can see here, we have this high, which is a balanced price range, and we have this imbalance through it. We did come lower to retrace into the gap, but we didn't actually tag it. So all of this is engineered buy side until we finally are able to come down and touch it. And then that's offered efficient, balanced price to this range, and we can finally expand upwards. So I just thought that was neat. So now, price will reject from fair value areas nearly to the tick if you pick the right one. So which one do you pick? Obviously, it can be pretty hard when there's so many highs and lows. However, okay, that's just not going to load. However, usually I like to see them around consequent encroachment of the gap or around equilibrium. However, that's in like an accumulation phase. The easiest way to spot it, just like in the other example I showed where I got stopped out, is where you just have clear expansions and retracements. So there's only going to be one. It's going to be super easy to spot. And here's a schematic from Zeussy as well that very clearly outlines this, where we have a low, imbalance through it. We're going to switch to a buy program on the lowest time frame, and then we will reject from here before we can finally continue to expand lower. So you might think, oh, we have this high here, we're starting to reject, but it's not until we actually tag this low that we're able to continue to expand lower. So now, why PD arrays? So the PD arrays just represent different like variants of balanced price ranges. So order blocks, breaker blocks, mitigation blocks, imbalances, liquidity. I just want you to take a look at this picture from previously and see if you can spot every single PD array. Just give you 1 second to pause the video. So here you can see this is an example of a mitigation block slash breaker block slash order block. So any sort of down move where we have a high, this is where price has been delivered efficiently, and then as we expand through here, this is where we would have our imbalance. Here this low becomes liquidity, so now as we chop up in here, engineer liquidity, once we come down here, we are inside of this order block, inside of this mitigation block, inside of this breaker block, inside of the fair value gap, delivering fair value, and we're also sweeping liquidity all three at the same time. And you can even stack SMT at this swing point for even further added confluence. And quick note on IFVGs, the reason why they work is because it's signaling a change in delivery. So if we're going to continue to run higher, when we're in a buy program, we're going to continue to expand higher, deliver fair value, efficiently deliver price, and then continue to expand higher. However, when we have an imbalance, we have a fair value area here. This could be like a breaker block, mitigation block, order block. When we come down and we start to close through this, usually we want to see price react from the fair value area if it's going to continue higher, or at least in this area just below it. If we close through this gap, that likely also means that we are closing through the fair value area because we're closing below the high of the first candle, which on the lower time frame is a fair value area. So an IFVG is just a low time frame fair value area failing to hold. So hopefully that helps, and comment down any questions you have.